Good morning. Welcome to Stock Market Today for Wednesday, February 26th, 2020. And I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at @Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today, where you can sign up for a free email where we get most of the content for this show, as well as give you daily stock ideas to consider. Hit your inbox every trading day before the market opens. So pressure continues as U.S. equities were sharply lower in Tuesday's trading, ending just off the session's lows. S&P 500 has declined by more than 3% on back-to-back days for the first time since 2015, and since 1987, there have been 10 such declines. Investors seem to be shifting their focus to the spread of the coronavirus outside of China. All sectors finished lower on the day, with energy and materials the worst performers. Staples and utilities were relative outperformers, though still lower on the day. Treasuries were stronger across the curve as the 10-year yield hit a new all-time low. Dollar was down on the major crosses. Gold finished off 1.6%. WTI crude closed down by 3%. And as we get to the desk this morning, futures have been all over the place this morning, now trading higher by about 40 basis points. Asian markets were broadly lower overnight, with Australia the worst performer. European markets are trading lower, with Germany underperforming. Treasuries are weaker, and the curve is steepening. The dollar is stronger against the yen and the euro. Gold is trading flat. WTI crude is down about 1% here in pre-market trading. So as we look at the S&P 500, we kind of went through this near-term support level like a hot knife through butter after back-to-back 3% declines for the S&P 500. We're now looking for support in the 3,000 to 3,100 range. And I do note that roughly around 3,050 is a 10% correction from the all-time high that we were at just 1 week ago. RSI has become oversold for the first time since August, and Chaikin money flow is bullish. So just kind of taking a look at what's going on here, right? Obviously, some near-term technical damage has done. All eyes are now on this 200-day moving average at about 30.44, which lines up with that 30.50 area that marks a 10% correction for the market. I would also note that that lines up relatively well with the October breakout from the summer consolidation. I'm not saying we have to get there, but as we think about levels and what's going on, what's interesting to me is our proprietary overbought, oversold indicators for the three main markets, whether the SPYs, the Qs, or the IWM, still have room to oversold conditions. So I think we want to wait for oversold levels on those short-term metrics and get a gauge for where the market stands relative to key support levels to get our guide. So what are we talking about in our market today? In our note, our market in a minute, S&P falls by more than 3% for a second consecutive day. Generally sees a near-term bounce. We look back at the 10 times that this has happened since 1987, and whether you're looking out 5 days, 10 days, or 21 days, basically 1 week, 2 weeks, and 1 month of trading respectively, you do tend to get a near-term bounce. Sentiment gauges move towards fear as concerns around the spread of coronavirus outside of China. And as we said, futures do point to a higher open here today. But you can see the damage that was done yesterday when we look at the power bars and look at the major indices. The Dow down over 3%, 1 to 7 bulls to bears. S&P 500 down 3.06%. 43 to 14 on the bull-bear ratio there. NASDAQ was a slight outperformer on the day, but the power bar ratio goes bearish here as well, 12 to 15. Same with small caps, which were an underperformer, 266 to 351 bulls to bears. Bonds rallied, sending yields lower. We'll take a look at that chart a little later in the show. According to the Chaikin Power Bar, large cap stocks are more bearish than small cap stocks. Major markets are mixed. Our stock of the day, Dropbox. DBX comes to us from the software space. Was down 5% yesterday, but does have a very bullish rating due to very strong earnings performance, very strong price volume activity, and positive expert activity. The financials are poor, but when we look at the 20 factors, we come out with that very bullish rating for a stock that's in a strong trend above the trend line. Strong industry groups. Software is still a strong group. Remember, we looked at that yesterday. And what intrigues me about Dropbox is what could be a personality change going on. Now, a personality change is when a stock goes from being bearish or neutral and underperforming the market to then getting a bullish or very bullish rating and beginning to outperform the market. At the same time, money flow has turned bullish. Obviously, it was this earnings spike that changed the personality of the stock. Stock is overbought, but I think this is an interesting name here. If the market can stabilize, and we can work off this overbought condition, there's an interesting opportunity here in a name like Dropbox. I think we want to add it to a bullish watch list today and monitor the situation closely. If the stock remains with a very bullish or bullish rating, continues to outperform, has bullish money flow, well, then that oversold setup points to a higher probability entry point, especially or if the market starts to stabilize a little bit above key support levels. So I like adding drop list to a bullish watch list today and keeping an eye on it. Really interesting potential personality change, just looking for an oversold condition. What we'd love to see is just a consolidation here in the $20 to $22 range, call it. Works off this overbought condition, get closer to oversold, setting up a higher probability entry. Turning now to our sector tracker, looking at the movement of the major sectors over the last 5 days, and it's very similar to what we saw yesterday. It just got worse, really. So let's think about what this means from a relative standpoint. Well, if we look at the top 3 sectors, that's still your defensive rotation, your defensive positioning, your defensive / bond proxy areas of the market holding up better: REITs, staples, and utilities. Healthcare, I expect this group to be volatile leading into the election. Financials under pressure as yields go lower. Discretionary coming under pressure around coronavirus fears. Materials, industrial, cyclical names, very levered to the global economy and what could be happening should the virus lead to a bigger slowdown than investors had been anticipating. Service, I mean, everything's under pressure, right? It's really just, at this point, if you're staying invested and you're a longer-term investor and you're looking for opportunities, you really just want to be highlighting the relative strength. Tech at the bottom of the list is not encouraging, as that is 20% plus of the S&P 500. So all sectors down over the last 5 days. Relative outperformers are your defensives and bond proxies. Our industry in focus today: telecom services, has underperformed the S&P 500 by 2.73%, and the power bar ratio hints at that is likely to continue. It's very weak with 7 bearish stocks and only 2 bullish stocks. It's currently ranked number 14 of 21 subsectors. Some of the indicative names there: Acacia, very bearish; Bandwidth, BAND, very bearish; and Viasat, VSAT, with very bearish Chaikin power gauge ratings. And as we look at the fund, I would say it's a mixed to bearish picture here for the fund itself. And the reason I'm saying it's mixed is because the ETF rating is neutral for XTL. There's your ratio. But the trend is now weak as yesterday's sell-off pushed the fund below the long-term trend line. At the same time, we have bearish money flow and continued underperformance. This fund has been underperforming the market for nearly 12 months, right? So it's been an area of the market, as the market's been working higher, it's remained in this consolidation. So it hasn't been a compelling area if you're doing your ETF work, if you're looking for ideas. Kind of not the best area of the market to be hunting for those ideas, right? We're looking at an overbought condition here for the overbought oversold indicator, bearish money flow indicating that it's under distribution. So, we have to start thinking, if we're looking at a group like this, about the downside range here being tested, right? $64 to $66 being downside support, but I don't see a lot that gives me confidence that we're likely to break out of this consolidation. Now, relative strength had been improving of late, but still not enough there to get me excited and to get me to think that this group is likely to break out in the near term. Best case, likely continue to be in the consolidation. Right now, we are in the middle of the range. Taking a look at what's trending now. Yesterday's S&P 500 gainers and losers that were movers and shakers. Hewlett-Packard's earnings sent that stock higher by 5.6%. With all the macro news and the coronavirus news, it's easy to kind of forget that companies are still reporting earnings. With the Hewlett-Packard print, Xerox goes along for the ride, up 4.5%, as those two are in potential tie-up. Regeneron caught 2 upgrades yesterday, which helped that send that stock higher by nearly 4% on the day. Also notice that it caught 2 more upgrades and a downgrade here this morning. Keys, KEYS, up 3% following their earnings announcement. And Perrigo had one of their drugs approved. That was enough to send this neutrally rated stock higher by 2.68% on the day. Loser side of the board, taking a look at that, American Airlines trades to a 52-week low, down 9%. Obviously, the travel and leisure areas of the market have been and remain under pressure due to coronavirus fears. We'll see that in a couple of other names here. Oxy down with crude oil, down 8.33%. Love, another airline stock, that's Southwest, down 8.2%. Live Nation, obviously part of that travel, leisure, and entertainment area of the market. Live Nation down 8% on the day, and same goes for Marriott, right? Lump that into the same group, down nearly 9% on the day. So let's dive into the charts now. On Wednesdays, we look at sentiment, and sentiment becomes more fearful. Now, we're looking at the CBOE equity put call ratio, and you can see we've backed off these overly exuberant readings that we saw back in the January timeframe due to fears around coronavirus, but we still haven't hit these levels that have really marked solid buying opportunities in the past. We haven't gotten to the point where fear is overly pervasive, at least not based on this indicator, right? A lot of work to do to get back up to those levels. We're not there yet. The VIX, on the other hand, is probably telling the more real-time story of what's going on with investor sentiment. Big VIX spike, right? When we were talking last week, or in our note, the VIX was down here with a 14 handle. Big spike over the past few days, up to 27 as the market has sold off. This tends to be very much a coincident indicator moving with the market. I will also point out, as I do in my note today, that the CNN Fear Greed Index is down to a reading of 22, and that is a level that is classified as extreme fear. But just for a little context, back in December 2018, that reading actually got down to a 2, single-digit 2, not 22. All right, so sentiment moving towards fear and away from greed, which you would expect here with the market selling off the way it has over the past 4 days and actually accelerating to the downside over the past 2 days. Taking a look now, one of the key areas that I'm focused on, as always, is semiconductors. And I'm pointing it out today because they've fallen back into this relative support zone. Top main panel of the chart is SMH relative to the SPY. So the VanEck Vector Semiconductor ETF relative to the S&P 500 ETF. And you can see we kind of went into this consolidation, above support. And we've now pulled back, right? Semis have been lagging with this sell-off. They've been going down harder than the broader market over the past few days to pull us back into this near-term support zone. Now, from a trend perspective, we are still above the 200-day moving average. But what's interesting to me is we've had a bearish divergence, right? As the ratio was making higher highs, the RSI was making lower highs, and we're really watching this zone closely now. RSI is still holding bullish ranges, has not become oversold, but to me, a breakdown from this zone, from this support zone, likely leads to more downside for the broader equity market. Remember, there's a positive correlation between this ratio and the broader equity market, and it tends to lead, right? You can make the case that we've started, if this is a topping formation, you can make the case that the top started right here at the beginning of the year, ahead of the top in the S&P 500. Should that be the case? So far, the SMH is still in an absolute uptrend, right? Here's that trend line. We're getting close to testing it at around the $130 level. But if you're bullish the equity market, or you're looking for signs of stabilization and a turnaround, you're going to want to see this support zone hold and see the ratio begin to move higher. A breakdown argues for lower prices for the S&P 500 based on past correlations in the relationship here between this ratio and the broader market. And then finally, we'll wrap it up with record lows for the 10-year yield, right? Flight to quality, flight to safety has led to investors gravitating toward treasuries. Taking a look at the 10-year yield, you can see we are accelerating through the downside, through this support level from the September lows, right? Interesting rally here. It's interesting because while there was some upside, it didn't have the momentum that we like to see. Never became overbought, right? Series of divergences as we tried to trade up to the 2% level and then faded below the moving averages. That's why your bond proxies and your defensive areas of the market are continuing to outperform here in the near term, and we are now oversold for this metric. So that's going to wrap it up for today. If you're interested in reading my note, you're interested in running through our process, take us for a test drive, head over to chaikinanalytics.com/test drive to sign up for a free 14-day trial I'm going to be back here with you tomorrow morning. Have a great Wednesday, everyone.